Asia Times, 14th of February 2024, MSCI's withdrawal from India and China equities reshapes the investment landscape. China has fabricated an environment for investment, which is currently on the verge of insolvency. A prominent global index provider, MSCI, Stanley Capital International, has decided to eliminate dozens of Chinese companies from its global benchmarks. This decision follows the tumultuous period in China's stock market, during which the value of trillions of dollars was wiped out. Concurrently, MSCI has increased the weighting of India in its global standard, emerging markets, index to an unprecedented 18.2%, signifying a turning point in the worldwide investment environment. The MSCI's assessment of India highlights the nation's strong economic performance and astute policy choices. MSCI included 5 Indian equities in its Global Standard Index review for February, with no deletions. This action signifies an endorsement of India's market's ability to withstand challenges and its potential as an appealing investment hub. Significantly, since November 2020, the country's weighting in the index has almost doubled, establishing it as the second-largest component, following China. Leading factors in India's ascent. Numerous elements contribute to India's increasing prominence as measured by the MSCI Global Standard Index. The 2020 implementation of the Standardized Foreign Ownership Limit, FOL, has primarily increased global investors' access to information and transparency. Furthermore, the continuous increase in domestic stock prices has enhanced India's attractiveness, demonstrating the nation's economic fortitude in the face of worldwide unpredictability. The comparatively weaker performance of other emergent markets, most notably China, has additionally shifted the balance in favor of India. On the other hand, excluding 66 Chinese equities from the global benchmarks of MSCI reflects the difficulties confronting the Chinese market. Investor confidence has been undermined due to persistent apprehensions regarding China's ailing real estate industry and sluggish consumption, reducing the country's weighting in global portfolios. The exclusion of Chinese equities by MSCI represents the most over 2 years and signifies a substantial change in investor sentiment. Response of global investors. The portfolios of investors worldwide are profoundly affected by the ramifications of MSCI's decision. Reducing Chinese stock holdings indicates a reevaluation of risk and an intention to achieve a broader portfolio. Investors, already apprehensive about the economic vagaries in China, might perceive India as a more secure and promising substitute. The diminishing significance of China in global portfolios prompts an increasing acknowledgement of the necessity to investigate alternative emergent markets, with India's elevated position gaining further appeal. Although some investors may view the divestment of Chinese equities as a risk mitigation measure, it also allows capital reallocation to regions exhibiting promising growth prospects. Due to its technological advancements, expanding consumer market, and economic restructuring, India is progressively gaining appeal among investors in search of alternative investment opportunities apart from conventional powerhouses. Investors on a global scale must recognize the risks and opportunities presented by these strategic shifts and adjust to this dynamic environment. With the investment community increasingly adopting a diversified approach, the rise of India in MSCI's indices signifies the beginning of a new era in global portfolio management. However, it would be imprudent to disregard China, which has repeatedly demonstrated its resilience.